Okay, we're getting ready to do financial accounting, chapter 10's intro exercises. Again, we're working with liabilities now that have credit balances. Anything that has the word payable is going to be a liability. So we're going to cover quite a bit about notes. Notes have to be paid back just like accounts payable, but notes payable usually involve time and interest. Okay. So a note is usually some form of a loan. Okay. Accounts payable is a loan too, but it's really not long enough. Most accounts payable are expected to be paid within 30 days. Okay. If you're a business to business, accounts payable, usually their terms are either pay upon receipt, or you got 10 days or 15 days or 30 days. Usually those are your most common time periods. Other than that, after that, they may start charging you interest and they may turn it into a note if you don't pay them soon enough. And then you're going to start owing interest on top of that. All right. So a note is a loan. All right. And most notes have an interest rate involved. A note has three things. It has a principal. Okay, so the principal is the loan or the amount that you're looking at. Okay, so we have the principal, we have an interest rate, and we usually have some form of term or time. Okay, so in this case, number one, and we want to do the date. So the date that this note is going to happen is January 6th. Okay, so we're looking at January 6th, 26th, excuse me, January 26th. So that's almost all the way through January. Remember, January has 31 days. Okay. On January 6th, we borrowed cash. So we're going to get cash for our loan. So I'm going to have a cash account here. And let me do a notes payable here. Notes payable. And it's going to have a credit balance because it's a liability. Let me put cash over here. And it's going to have a debit balance because it's an asset. Okay. So debit balance, and this is going to be cash. So we're borrowing money from this bank. And by the way, most of the time, kind of like accounts receivable and notes receivable, each note is specific to a financial institution, right? Or a customer. So remember, cash is an asset. So we're going to make cash go up for the amount that we're borrowing, right? So the principal of our note in this problem is $150,000. $150,000 in my note. So you look and see, it's also known as the face. Note, loan, face, principal. All the same thing. Okay, so I'm trying to give you all the buzzwords for, okay, so face, the face of the note. Okay, it's good to know that word face because we're going to need it in chapter, I think it's chapter 11 that we're going to need it. All right. So the face of the note is $150,000. We have an interest rate of 10%. Okay, so we want 10%. And let me show that as a percentage here. And then our time. So we're gonna have a note that has a 60-day term. Okay, 60 days. We'll put 60 days right here. So there are the terms of our note. Note terms. And when I do problems, I always put those note terms above any notes payable that I'm going to be working on so that I don't forget that information. By the way, this notes payable is going to be to the Conrad Bank. Now, I don't know if they're going to put that on. Oh, they're not even having us do the entry, but if we were to make an account, the Conrad Bank would be on this note payable. So we don't pay somebody we didn't mean to. Okay, here we go. All right, so here's how you calculate. So determine the proceeds of the note. So the proceeds are how much you get to use at your discretion, right? So this is what they call a simple note. Believe it or not, there are other kinds of notes. This one is called a simple note. A simple note has a principal, an interest rate, and terms. Here's how you calculate the interest that you'll need to pay on that note. But just so that you can see it, I'm going to show, this is January 26th. Okay, January 26th, here comes $150,000 in cash. We're going to record that. Now, I know they're not asking for a journal entry, but that's what it would look like when you establish the note. So now we've got $150,000 to go do whatever we're going to do for our business, grow our business. But we are paying a 10% interest, right? So let's go ahead. What are the proceeds of the note, assuming the note carries an interest rate of 10%? Well, the proceeds is the whole amount of the face of the note. So that should be 150,000. Okay. Okay. Now, if this was a discounted note, all right. So they're trying to show the difference between a simple note and a discounted note. All right, so this is something to understand. So once again, this is simple. So next to it, I'm going to put discounted note. Let me put discounted note here. So this is going to be, and I'll put this above here, simple. So we know which one's which. And we're going to do this again. All right, so hang on just a second. I'm going to put simple, put discounted. So let me move this down a little bit. Okay, and then there's a note called a discounted note. Okay, so once again, a simple note, you get all of the face. So you can use that money however you would like. But a discounted note actually subtracts, it discounts your proceeds by the amount of the interest. So I'm going to put cash here again. And I'm going to put, it has a debit balance. And then this note payable is also from the same bank. But we're just trying to explain to you the difference between these two kinds of notes. So the recording of the note. Okay, so, all right, so here is how a discounted note is calculated. So I'm going to go ahead and finish this simple note. So a simple note, the interest, although they're not asking that, I'm going to teach you how to calculate the interest payment. The interest payment on this note is this. Okay, and I'll put it in parentheses over here so you know it is the principal of the note, which mine is $150,000, times the interest rate. Times the interest rate. Leave your interest rate intact. Don't mess with your interest rate. Some people do. I don't. You say, I don't understand. Don't worry about understanding that. Just always put in what they're telling you. Now I'm going to put in 0.10 to represent the interest. Now, here comes the time. Interest rates are always stated annually. Interest rates are stated annually. I can't say that enough. Interest rates are stated annually. You say, what does that mean? I'll tell you. when you look at an interest rate like 10%, we would pay 10% on this note if this was an entire year note. But the term is not 365 days, it's only 60 days. So the interest payment that we're going to calculate is going to be 150,000, which is the loan, times the interest rate. And now here comes the time. The time is what I manipulate. We're going to say 60 days over 365. Okay, so this actually needs a little parentheses in the middle, if my memory serves. In the middle, okay, so we're going to mess with the time. What I mean by mess, I mean adjust the time. If this was 1 year, it would have said a 1 year note or a 365-day note. And then we could have just used the number 1, right? But we can't. We have to turn the third part. So there's the face or the principal. There's the interest rate in the middle. And then there's the term or the time, however you like to think of it. If it's less than a year, you've got to do a little manipulation of that time. So now let me show you that calculated in Excel. So I'm going to say equals, open parentheses, $150,000 times 10% times, open parentheses, 60 days divided by 365, close parentheses, okay? That's why you went to algebra class, by the way. That's why you went to algebra class. You said you'd never use it. Now you are, okay? Or at least part of it is. All right, I'm going to hit enter. So I got, okay, and I'm going to double check my math. Okay, double checking my math. 10%. So 10%. And what do I have as the interest payment? Okay, so I have something not correct. Let me see what's happening here. Okay, I'm just going to put this in just like this. So 60 over 365, 60 times 365, or 60 over 365. 60 days divided by 365 days is 0.1643. So it's not an even number, okay? And my interest rate might be out of whack. So I'm going to just put 0.1 there. Okay, nope, it's still okay. I'm just not seeing that. Okay, so now let me do it all right, so equals 150,000. Okay, now I think we're good. All right, times, my brain just wasn't seeing it, times 0.1 times 60 divided by 365. So I know I'm second guessing myself. That's okay. I'm just double checking. Yes. Okay, so that's the amount of interest that we will owe on a simple note when it comes time to paying that back after 60 days. So the and I know they didn't ask that, okay, but now let's move down to the discounted note. Okay, the discounted note is calculated exactly like this, except for one thing. The note proceeds, okay, note proceeds of a discounted note subtracts note proceeds of discounted note, subtracts the interest first, okay? So you do find the interest just like that. So the loan proceeds are $150,000, okay? So equals $150,000 minus the interest, okay? We found the interest payment. That's the loan proceeds. Now I'm going to show you that in a formula here. So equals at 150,000 note times the 10% times that 60 over 365. Okay. And then, all right, that is, and then I need one more. All right. So what's going on here is you're taking the loan proceeds and subtracting the interest. So if we start off with $150,000 note and figure the interest, then we will get those loan proceeds. Okay, so you've got to calculate the interest on either note, but there is the formula, right? It's the loan minus its interest. This is the interest. The interest is $2,466. So let me put one more display here so that you can see it, right? So we're showing equals 150,000 minus the 2466. Okay, minus the 2466. That is what we're getting. So the proceeds. So are these notes the same? The answer is no, they are not. So the cash we're going to receive is $147,534 for a discounted note. Okay. Now we always put the face of the note in notes payable. When we do this journal entry, we are not balancing. Nope, we're not balancing. So the answer is you are going to receive $147,534. Even though these are the same note, one is considered a simple one or an interest-bearing note, and the other one is a discounted note. A discounted note, one more time, subtracts the interest before you get the money. So you say, well, how do you make this journal entry balance? You use another account. The other account you're going to use is interest expense. Expense. We are the ones paying the interest. Okay, so interest expense, and it comes right off the top of those loan proceeds. Okay, loan proceeds. So we're already going to record at the beginning of that note the amount of the interest. Okay, so this is how you put a discounted note in as a journal entry. And guess what? I have it on the wrong side because I was thinking of interest revenue. So let me try this again. Okay, let's see if we're working now. If we get $147,534 from a discounted note of $150,000, then at the same time we're getting the proceeds to make the journal entry balance. We're actually going to record the interest right away when the note is issued. Okay, now I know they didn't go into all that, but they're just about to. Okay, they're just about to. So you have to be able to know what kind of a note they're talking about. For the most part, we'll be doing interest-bearing notes. A discounted note. A discounted note is usually offered to maybe a business that's credit is not so great. Because they're already paying the interest right off the bat, right? Let me ask you, which would you rather have if you're a business? Would you rather have $150,000 to spend, however you want to, or would you rather have $147,000 to spend? You'd rather have the $150,000. That note is more beneficial to you, even though you're going to end up paying this interest in 60 days. When this note gets paid, we're going to pay $152,466. We're going to pay the loan amount plus the interest when we pay back our simple note, right? Okay, that's enough. Moving on. Just wanted to try to make sure I explain as much as I know how to. Because like I said, this was rather difficult for me. The other thing we're going to concentrate on is payroll. Payroll is a good subject. Why? Because a lot of us get paychecks. And a lot of us have no idea how we're getting paid. Okay, none at all. And we all should have some idea of how our paycheck gets calculated. Okay, but if you're an employee or an employer, you have to keep a bunch of notes, a bunch of payables that you pull out of people's paychecks, and they're going to go in payables and they get pushed on to other entities that have to do with payroll. So give me just a second. I'm going to put down a couple of things here. All right, this is employee net pay. Okay, employee net pay. So we want to get an idea of, now, what does net pay mean? Does anybody know? The word net means something's been subtracted. Yep. Net pay, something's been subtracted. And if you look at the bottom of your paycheck, it's smaller than the amount at the top. Okay, net equals something's been subtracted. And most of us look at a paycheck and go, yeah, a lot has been subtracted. So what comes out of our paychecks? Mainly taxes, right? Mainly taxes. What kinds of taxes? Income tax. In this state, we have state income tax too. We are not dealing with state income taxes, but only federal, okay? And they will tell you how much it is. You don't have to calculate that, okay? But the second piece that you may not know is you pay in Social Security tax whenever you work a job, right? You pay in Social Security tax. Well, how much? You pay in 6.2% of your gross earnings. And you're not paying it in, your employer is pulling it out of your check for you, because we are not responsible enough citizens to pay in our share. An employer has to pull it out for us. You want to know something cool about Social Security and Medicare? You may not know. Your employer's got to match that. Yes, they do. So every time you send 6.2% of your earnings to Social Security, and Medicare gets 1.45 of your earnings, your employer's got to go, I got to put that into. On top of your earnings. Everybody understand that? It's on top. I didn't really understand that when I was first starting off working. I was like, whoa, okay. So so this is extra earnings that your employer's paying on your behalf to Social Security and Medicare to hopefully help take care of you when you're a senior or retired or whatever. All right. So let's figure out what net pay is. We're going to start with the gross pay. This is a weekly pay. I'm making on March 9th, $3,140. So we're going to put gross pay down. Okay, gross pay. You know, I like dates because you never know when you're going to have to worry about a date somewhere in the problem. So March 9th, and this is the period. You know, you have pay periods that begin on a lot of people's pay periods begin on a Sunday or a Monday, and they go through Saturday or Sunday, right? Because if you're paid hourly, and if you're in the right industry, you can get overtime, right? So overtime is usually time and a half of your hourly pay once you've worked 40 hours in a given work week. All right. So, all right, here is my gross pay. Let's put that down. Okay, my gross pay is $3,140. Okay, now we're going to pull some things out before we get our net pay. And once again, they've put the burden of this. They is the government. The government has put the burden of collecting this money on the employer to pull it out of your check and put it in a liability until they send a check to the IRS and to the Social Security and Medicare agencies, okay? So that's not their money to mess around with. That's their responsibility to pull it out and send it to them. And if they don't do that, they can get in a lot of trouble. And not only, once again, do they have to pull out your amount, but then they have to send a match of both of those. So what is the net pay for Lindsay? So what we're going to do is we're going to subtract the federal income tax. We're going to figure out our calculations first, and then we will subtract. So don't subtract your federal income tax before you calculate your Social Security and Medicare, or you'll get it wrong. Okay, so I'm going to put deduct federal tax. Okay, and I'm just going to put a negative of however much they're telling me. Okay, and they're going into cents now, so we're going to have to watch that. We haven't dealt with 2 decimals to the right of much in this class, but that will be deducted. Now we're going to do Social Security. Social Security is 6.2% of your gross, of the gross. So if you try to subtract the federal tax before you calculate your Social Security, it won't be right. Okay, so Social Security is 6.2% times the gross. Okay, so let's see if we can make that happen. 6.2%. All right, so I'm going to put that beside it, turn it into a percentage, and then increase the decimal. All right, so what we're going to do, the amount that's going to be subtracted is a negative. We're going to take our gross pay times 6.2%. Okay, 6.2%. And that is how much is going to be deducted from your check or from an employee's check and sent on when the time is right. Okay, Medicare. Medicare is 1.45% times the gross. Oops. And then we're going to do that, and then we'll subtract everything. Okay, now luckily there's a lot of good payroll programs that will let you that will basically do this for you if you are an employer or a business. However, you should be able to calculate this based on your paycheck statement, right? And if you get a paycheck statement that you don't understand, then I would go to payroll or go to someone at your work and say, please help me understand how I'm getting paid. And you'd be surprised how many people don't really understand that very well. I was one of them. I used to be somebody that didn't understand how I was getting paid. It's like, why do I need to know that? Well, but to make sure it's being done right, first of all, right? You want to make sure you're getting paid right. So the amount of Medicare that will come out of this is the gross amount times that 1.45%. So, I forgot to put a negative. So we're going to make that subtract. And now we're going to get the net pay. We've got 3 deductions that are coming out of the paycheck before the employee gets paid. And now the amount that actually goes to the employee, if my calculations are correct, is $2,366. Okay. Now, here's one way you can do this. Yeah, so that's what you got. Net pay. Net pay. You have to make sure to take those Social Security and Medicare amounts times the gross, or it will not come out right. Let's see if I'm right. Make sure I'm following things the way I should. All right. So you could make yourself a little template to put in the gross, to deduct the federal. Make sure your Social Security tax and your Medicare tax is being taken times the gross. and then it gets subtracted. So net pay. So this is going to be part of this chapter, okay, is employers paying employees, because that becomes a liability to them as well, right? Wages payable, salaries payable, bonuses payable, any kind of way that you can compensate an employee. A lot of times you put it in a payable first. I get paid once a month. Okay, so I work a whole month and then get paid, right? So a lot of places pay every other week. That's biweekly. Some places pay twice a month, which is not the same as biweekly. Twice a month, you get 24 paychecks. Biweekly, you get 26 paychecks. It's a difference. Yeah, some people are fortunate enough to get paid weekly. Now that is a boatload of burden on employers, pay people weekly. I can't imagine if somebody was to get paid daily. Woo-hoo-wee. No, 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 no. Okay, so anyway, all right, onward we go. All right, so how about the payroll taxes? All right, so once again, I said that employers have to match the taxes of the Social Security and Medicare of their employees, right? Okay, so now we're going to do journalized payroll taxes. Okay, so let's see if we can't get a little picture of this to help us out. Okay, so this is payroll taxes, and we're going to journalize them. Journalize payroll taxes. Okay, so I'm going to put some T accounts. How many T accounts do I need? 1, 2, 3, 4, 5. How do I know that? That's how many lines I got. So I'm going to need 5 T accounts. Okay, so we'll make some room here and put those in there so we can see them and which ones they're talking about. So I think I've got 6 here. Let me grab these. And we will throw these in here and name them what we need them to. So we'll blank these out. I love little T accounts because you can see what's happening. All right, so there's our 6 T accounts. I'm sorry, we needed 5, but we've got 6. That's all right. So the payroll register of Heritage Company indicates $5,580 of Social Security is withheld on total salaries of $90,000 for the period. Okay. Earnings of $27,900 are subject to state and federal unemployment tax. Okay, so this is payroll tax from a business point of view. So now let me show you what we're looking at here. And I'm going to list the taxes that we have to worry about for employers. Okay, for employers. This is not paying employees. This is paying the extra that employers have to pay because they have employees. Just because they have employees. So just because you have employees, you have to pay extra money besides just their wages. Yep. So this is when you hear businesses talking about the payroll taxes are killing us. The payroll taxes are killing us. Well, this is what they're talking about. They're not necessarily talking about paying people. They're talking about the extra that they have to pay. All right, hang on just a second. I'm fixing this. Okay. So what do employers? So this is the extra taxes paid on top of wages. Okay, extra taxes paid on top of wages of employee wages. So if you have employees, you got to pay this extra stuff. The extra stuff, there are 4 things. Okay, 4 things you have to pay in as an employer. So let me list them. The first one is you have to do a Social Security match. Social Security match. You have to do a Medicare match. You have to pay in state unemployment. State unemployment. Now, employees don't pay into state employment. The employer does. Okay? Unemployment. Unemployment is used for employees who are no longer employed, right? That either had to get laid off or furloughed or quit or fired. Now, sometimes you don't qualify for unemployment, but this unemployment is an insurance policy that the employer pays. The employer pays in, and states are usually the ones that supply the payment to employees. So I'm going to put that this is an insurance policy. It's basically an insurance policy for employees to have some money coming in while they find a new job. Okay? Yeah. For employees when finding a new job. Finding employment, basically. So the employers are footing the bill for unemployment. So don't let anybody tell you that as an employee that you're paying into unemployment. No, you're not. It's your employer that is. And the other part is a federal unemployment. Okay, there is a federal amount of unemployment that acts like an insurance policy also. And usually it's enacted when something tragic is going on in the country, like COVID or something like that. So it's not usually, like right now, if you filed for unemployment, I don't think you would get any federal unemployment because they have not implemented that. They only implement it when it's necessary. All right. So now I'm going back to the problem. So those are the 4 things that you have to pay as an employer. So we're going to have Social Security payable. We're going to have a Medicare payable. We're going to have a state unemployment payable and a federal unemployment payable and a cash account. All right. So I'm going to have a cash account. Nope. I'm going to, okay. Just a second here. All right, so payroll tax expense. Payroll tax expense is going to be an account. All right. We're going to have Social Security payable. Okay, so these are some new accounts that you would want to pay attention to. Okay, and then a payable always has a credit normal balance. Then we're going to have a Medicare payable because they are separate payments. So we want to keep them separate. And then we're going to have a state unemployment. By the way, state unemployment is known as SUTA, SUTA. If you ever see those initials at a business, that is referring to state unemployment, and they're saying state unemployment tax is 5.4%. Okay, so I want to put those percentages down. Okay, so SUTA is 5.4%. And that's, once again, that is a tax that the employer pays. Okay. And they pay it on a certain amount of income. Why is that not wanting to do that? Okay. Here we go. No. 5.4. Okay, let me show this. So I got to go out. There we go. 5.4%. The other one is called FUTA, Federal Unemployment Tax. And they're saying it is 0.8%. So we definitely want to be sure to make sure we've got the right number here. Okay, so this is going to be 0.8%. So that's not even 1% there. So be careful. Be careful. So we're going to make a SUTA and a FUTA payable. Okay, so let's do that. So this is going to be a payable, a credit balance, and then we're going to do a FUTA payable or something similar to it. All right, and it's going to have a credit balance. Now we've got to calculate how much each of these things are in our problem. All right, so I'm going to put that beside on the left side of the description. All right, so this is what they're saying. So our employees had withheld $5,580 in Social Security, right? We've got to match that. So we're going to put money aside for that amount in the payable, all right? And then 1305, we've got to match that Medicare amount. Okay, so these are the amounts that we're going to calculate for all four of these items. And then they're all going to be lumped in under payroll tax expense. Okay, payroll tax expense. So here we go. All right, so then the state unemployment. Now be careful. Federal or the unemployment is oftentimes subject to a different amount of earnings. Okay, they say that the earnings of 27,900, that's all the earnings. And by the way, our Medicare taxes, our Social Security Medicare taxes are on the total salaries of $90,000, but our federal and state unemployment tax are only subject to a certain amount of earnings. Okay, so let me put a little note for that too. I'm going to put this down one and this one down another. So let me get this in here to make sure you know. So these two are subject to $90,000 total salaries. Okay, but these two are subject to 27,900. Okay, subject to, and a lot of times there's a difference. I wish there wasn't, because they'd have to pay in a lot more and maybe people would be covered better, but subject to $27,900 in earnings. So whenever we take the 5.4% and the 0.8%, we're going to have to use 27,900 for this. And this one's already been figured for us, but I'm going to put it there anyway. So how much in state unemployment? We're going to take our 5.4% right here. Yep. And we're going to take it times the $27,900. Whoops. And I want this as a, okay, so let me try this again. There it is. Okay. And we're going to do that for the Medicare also. We take the earnings times the 0.8% that I've got over here, 0.8%. And there you have it. So one more time, this one, let me put this one in again. When you figure your state unemployment tax, you use the amount of the earnings that they're telling you to times the times this percentage here. So this is, once again, this is an amount that the employers have to pay in on top of employee wages. So this can be quite a burden for an employer, okay? It's definitely extra expense that a lot of them would rather not have to pay, because, you know, cutting costs helps you increase the bottom line. I'm going to add up all of these. I'm going to add up all of these extra payroll expenses on top of wages. Okay, so I'll drag this down. Nope. We'll just do it. Sum equals. Drag this through here. Yep. And close parentheses. So there's how much in total extra payroll expense that we have to pay in for having employees. So here's how it's going to go. This becomes your payroll tax expense. So I'm going to do it just like I did. So let's go to the second one. Let's pick Social Security tax payable. Don't pick the expense because that's not how it's going to work. All right. So the Social Security, we're going to pay in $5,580 more. So we're putting that in the payable. And then we're going to put this in Medicare tax payable, the amount that we figured, $1,305. And then let's go get the state unemployment tax payable, which we called SUTA. Okay, we called SUTA. And let me go ahead and put these numbers in here. So this is $5,580 that we're putting in the payable and $1,305 in Medicare payable. And then the SUTA payable is going to be what I found here. Let me make this smaller so I can see it better. There we go. Okay, this is going to be a payable of $1,506.60. And then the federal unemployment tax payable, $223.20. So there are those four amounts. And then the offsetting debit is the total. Okay, so the offsetting debit equals all of those credits. Okay, all of those credits. All right, so the last one is federal unemployment tax payable. Okay, we got 1506.60. So you're going to have to put your numbers in because I think this is an algorithm problem. Okay, and then this is all payroll tax expense. Okay, $8,391.60. So you see how you have to figure out all those payables first, right? How much you're going to have to pay in. And then you wait to see what those total and then make this the offsetting debit to record that journal entry. I think I'm right. Let's check it. Okay. Uh-oh. Hang on a minute. Let me see what I did. So all of these are okay. Let me see if there's a rounding thing. Okay. Sometimes Excel does this. Okay. Sometimes it does this when you take things times 1.45. So here's what I'm going to do. I'm just going to repeat this. Hang on. Actually, here's what I'm going to do. I'm going to take this number equals what we put in here. So I'm going to make it equal all these credits. Okay. Equal all the credits added together, which is what it should be in the first place. There's that one. Okay. So I need one more. Okay. I need one more, which should be here. Oh, and then I also want to make sure these are being displayed with their cents. So hang on just a second. We'll do that. Now let's see if it makes a little difference. Yep, it does. I guess it does because it says round your answers to 2 decimal places. Okay, so it looks like it's 83.9160. And this becomes part of these? No? Okay. Oh, nope. Look at the difference. 20, no, a little bit different. Hang on a minute. What did I do? Why are we getting such a difference? That doesn't make any sense. Okay. 223. Oh, I see it. It didn't add up everything. Here's why. Yep. There we go. Now it matches. Woo! I was going to have to go lay down. Okay, there we go. All right. So you just have to, so just because you think you know, doesn't mean you know, but you got to find these and then add them up. All right. Are you fixing to go? Did you get them done?
I only have one more.
Okay, well, that's good. Okay, let's talk about vacation pay. Vacation pay becomes a payable. Vacation pay is a benefit. It's a fringe benefit. Do you know who you can thank vacation pay for? Do you know who you can thank for vacation pay at a job? I know you might not like to hear this, but it is unions. Unions. Without the unions, you wouldn't have a 40-hour week. You wouldn't have weekends. You wouldn't have vacation pay. You wouldn't have sick pay. You wouldn't have fringe benefits. Is there a law that says that a business has to offer vacation pay? No. They don't have to offer you anything except for paying you the wage they agreed to pay you for the work you've done. All right. So, paying people with vacation and sick leave, we often keep accounts that show those the pay that we're paying people vacation wise separate. Okay. We want to keep it separate so we know what we are paying people in vacation. All right. So let me bring in this down here. Okay. All right. So this is number 4, I think. Golly, I know these are taking a while. Sorry about that. 1, 2, looks like, 3 is down here. All right. So I'm actually working on number 5. Sorry about that. Okay. All right. Vacation pay. So it provides employees with vacation pay and something called a defined benefit pension plan. So a defined benefit plan, which doesn't happen very often anymore, that's actually money that your employer is setting aside on your behalf. Okay. It's not your 401k, which is your money. Sometimes employers put money in 401k for you, but a defined benefit plan is money that your employer set aside for you without you contributing to it at all, which doesn't happen very often anymore. All right, so we're going to look at this based on some journal entries here. Okay, employees earned vacation pay of $19,000 for the period, and the pension formula determined a pension cost of $141,000. Only 84,600 was contributed to the pension plan administrator. So usually a pension plan is held by another financial service so that those stay separate. Okay, so journalize the entry to record the vacation pay. Okay, so we need a couple of T accounts here to learn a couple of new accounts. And Gavin, just go whenever you're done. That's fine. I appreciate you coming in because I'm going to finish with this recording. Thanks for coming in.
Yeah.
All right. We will see you next Monday. And Zoomers, if you need to bug out, go ahead. It doesn't matter. I'm going to keep going. Okay. So I want to get this done in case somebody needs to watch it or go back to a problem to understand. Okay. I wasn't as prepared for this. I thought I had all this in a nice spreadsheet, but that's all right. Okay. See you later. All right. You too. Okay, Zoomers, you are welcome to go if you need to, or stay with me. It's up to you. Up to you, but I'm going to stick it out because I don't want to do this again. All right, so one more time, I'm going to grab some T accounts here and bring it down here so we can see these journal entries. And this has to do with vacation and pension. Okay, vacation and pension. And so this is going to involve payables for both of these as well, because you've got to set aside. A lot of places like to have an estimate of how much vacation they have, how much pension is being accumulated for their employees. So, a lot of times that's what happens there. So let me push these down. Like I said, I'm not quite as ready as I was, but it's okay. Okay. Now I want some T accounts. That's, that goes down here. All right. So vacation pay and pension. All right. So I'm looking in the book, okay, because sometimes I don't deal with this stuff a whole lot. I have to reacquaint myself with what we're doing. All right. So vacation pay, once again, vacation, medical, retirement benefits. Those are all known as fringe benefits. They're recorded separately than pay, right? So this is additional costs to an employer for having employees, kind of like those payroll taxes that we were looking at. Okay, so this time we're going to have vacation pay expense, and then we're going to have a vacation pay payable. Okay, vacation pay payable. And if they had sick pay, they would probably keep it separate also. All right, so an expense has a debit normal balance and a payable has a credit normal balance. And now, and then we're going to need a pension expense. Okay, pension expense. Because once again, this is money that an employer sets aside for you for your retirement. So you don't add to it. They have a defined benefit. And if you're lucky to find a job that has one of these, you ought to think about holding on to it. I'm also going to put a cash account up here in case we need it. Okay, so defined benefit plan. Okay, defined benefit plan. All right, so let's do the first one. The first one is an entry for vacation expense. Okay, so it says they earned vacation pay of $19,000 for the period. So we're going to put $19,000 in here. Okay, as an expense, vacation pay expense. And we're going to put it in the payable. Now, when they say they've earned it, that doesn't mean that they're taking the vacation pay. They're just setting aside this vacation pay for when employees are ready to take it. Okay, ready to take it. You say, what do you mean? Well, if an employee takes vacation, instead of it being a wages payable, when an employee takes vacation, they'll actually take it out of this payable. All right, so that first one should be all right. Okay, now the next one is a pension formula determined a pension cost of $141,000. $141,000. So the cost of the pension, okay, I'm going to put cost of pension, should be here. Okay, so it should be 141,000 is the cost, determined a pension cost of 141,000. Okay, so all of that is going in the pension expense. The other account we need when it comes to a pension benefit is something called unfunded. That's weird. Unfunded pension liability. Unfunded pension liability. So this is going to be a liability that we still need to pay. So we're going to fund $84,600. So down goes cash for $84,600. And then the rest of it we owe. Okay, the rest of it is owed. So if you take 141,000 minus the amount that we've paid in cash to the plan, we'll find out what the equals minus the amount paid in cash here of $84,000. That means we still need to fund it $56,400. So all of this becomes the expense to the employer, but this is something they've agreed to do. This is something that is hopefully going to attract employees. Okay, so the cost is, and keep them, the cost, and then cash is going to go down with the amount they actually contributed, which is the 84,600, and then the rest is going to go in a liability that needs to be paid of $56,400. Okay, so that's an unfunded pension liability. That can get pretty big if you've promised. So you may, that's why a lot of businesses don't offer this anymore. In fact, a lot of businesses don't contribute to a 401k anymore either. Okay. Sometimes a business will have a 401k match. Sometimes there are some employers that match 401ks, and that is a defined contributed plan, where this one is a defined benefit plan. All right. Defined benefit. Defined pension benefit means that only the employer puts in, but a defined contribution plan is both. Okay, is both the employee putting in and the employer possibly matching some of that. So that would be like your 401k. Okay, so let's keep going. A little bit longer now. All right, now we've got a payroll register, okay, that we're going to do. So I'm going to stack all these on top of each other, and we're going to actually pay. So this rally should have happened up here. So we have one, let me go back. We have 1, 2, 4, 5. So I misnumbered these. 1, 2. So this really should have happened up here after 2. All right, so that would have probably made more sense. So let's go ahead and make room for it to go up here. I'm putting it in. Okay, so sorry about that. So we figured out the net pay for one employee. Now let's do the journal entry for paying all the employees. Okay, so we're going to need some T accounts. And this is going to be number 3, even though we're doing it as the 5th problem. Okay, so now I'm going to grab these T accounts here and bring them in. We may need more than this, but we'll get us started. We'll put our information in. Okay. All right, we're definitely, let's look here. Let's look here. It says the payroll register indicates Social Security withheld. Okay, so hang on a minute. Let me just wipe out this stuff in my T accounts so I'm not messing with it or get confused. Okay, there we go. All right, so we're going to have, okay, so let's do a little figure here. So let's put in our amounts and then we'll put them in. All right, so we're going to need, it says the payroll register. What's a payroll register? It's a multi-column report to assemble and summarize the payroll data at the end of each payroll period. So when you pay people, you have to pay them their net pay, but you're going to expense all of their pay as wages and salaries expense or something. So let's see what they've got under expenses. They've got salaries expense. That is the account that they're going to put all of their salaries expense. Okay, so let me put these in. This one is going to hold all of what they paid, all of the gross pays of their employees. That's what goes in here. The total gross pay, whatever it is, total gross pay of employees. Okay, that's going to go there. Now we need some payables. We need, here they are. Here's the payables over here if I'd look in the right place. We need Social Security tax payable. We need Medicare tax payable. We need employees' federal income tax payable. So it's whatever they're telling us. So our total salaries of the period are 85,000. Okay, that's this one. Okay, so then we need let's look at the payables to help us with. So we're going to need a Social Security tax payable. Okay, so it says, okay, the payroll register for the period. So we're going to have a salaries payable. So the salaries payable is going to hold what we owe the net pay. So this isn't payday, this is getting ready for payday. Okay, so we're going to put salaries payable, then we're going to go over and put Social Security tax payable. We'll try to make this easier. It's going to be a credit. Okay, and then we have Medicare tax payable. Okay, and it's going to have a credit balance. Oops, and then we're going to have federal, now be careful, we have employees' federal income tax payable. Yes, notice we don't want to get that confused with anything else that has federal. Okay, so federal employees, federal income tax payable. Okay, that's what we're going to put down. So whatever we withhold, employees' federal income tax payable. Okay, so it's going to have a credit balance. And then what else do they show? All right, let's see what else. Oh, retirement savings. So retirement savings withheld. So the retirement savings deductions payable. So we're going to need that. Retirement savings deduction payable. Okay, and it's going to have a credit balance. Yep. It just so happens, I don't think we have any problems that talk about a state income tax payable. Okay, so, but that'd be another one. So there's a lot of payables involved with payroll. So once again, total payroll is 55 or 85,000. Social Security is going to get, so here's how you do it. You put a credit in whatever they tell you is the Social Security, or you're going to take 6.2% of the gross, which is 6.2% of the 85,000, but they are telling you what they are withholding. So you don't have to calculate it. So it's going to be 52,000 or $5,270. Medicare is being withheld. Okay, this is not the match. Okay, this is not the match. This is the employee portion. Okay, the employee portion. So bear with me a second. I'm trying to break this up. Just a second here. Okay. All right. So then the amount so the payable for Medicare is $1,233. And I'm going to change these all to dollars and cents here in just a minute. And then the amount we pulled out for federal income tax is $22,900. And then finally, the last part is the retirement. So $2,300. All right. So let me make this just a little bit smaller so you can kind of see them all together. So I want to put all of these in dollar amounts with the cents on the end so that in case we have cents, but I don't think we saw that. So here's what we need. We need to add up all of these amounts, okay? All of these amounts. We've got a credit. So here's this debit, right? The debit is the salary expense, okay? So we're going to put, all right, so the amount of the payable is going to be this debit minus all these credits. So this becomes a plug number. Okay, this is a plug number. You wait and see, plug number, what this is going to be. Because if you add up all of these 1, 2, 3, 4, 1, 2, 3, 4 amounts, you're going to find that they don't equal 85,000. Okay, they do not. Okay, so let's go ahead and add these up just so that you can see it. Okay, so the Social Security tax payable, and then the Medicare tax payable, and the employees tax, federal income tax payable. And then the last one is the retirement. Okay, so we're going to add these together and see what happens. All right, so when we add these together, okay, we get 31,703. Well, that definitely does not balance with 85,000. So if we have 85,000 here, then let's subtract to find out how much this payable will be. Okay, this payable is the difference. So that's actually the net pay that's going to go set aside for now, right? So here's what we've got. This is going to equal what this says. Okay, that's going to equal what that says. And I want to make these numbers have 2 decimals so that we don't lose any cents. Because when you're dealing with payroll, you've got to use 2 decimals, even if it's 0, 0. All right. So now we're going to journalize. This is called the journalized period payroll. That's what we're doing. Journalize period payroll. But we're not paying people yet. We're putting the pay that will go to them in this payable. And then when payday rolls around, we will back this out of here with a debit and credit cash. Okay, so let's see if we can put this in now. This is December 31st. So let's put this in, December 31st. Okay, the first thing that we're going to put in is salaries expense of 85,000. Okay, that's the debit. Now here comes the rest. Okay, then we'll put salaries payable at the bottom. Okay, salaries payable at the bottom because we have 1, 2, 3, 4. Let's put it at the bottom because it's the plug number. It's the plug number. So you could put all this in and wait to see how much you need there. So then I'm going to borrow these, okay? We're going to borrow. The first one we're going to put in is Social Security tax payable. Let's see if that's okay with them. If we put that in, yep, and Social Security tax payable, according to them, is $5,270. That should be 6.2% of that 85,000. So just for kicks, I'm going to check if they're following what they're telling us or not. They may not be, but I'm going to check it. Okay. But you should check your paycheck when you get paid. All right. So 85,000 times 0.0062 or times this right here. 5270. Hey, it does match. That's good. Okay. It does match up. So we're checking their work too. Okay, we're checking their work too. Let's do the same thing. Let's take the gross pay times the Medicare of 1.45. All right. So they rounded it. They rounded it up. Right? Yep. They rounded it up, but in actuality, we wouldn't round that up in the real world. Okay. Now, I don't know how there's a certain calculation for federal income tax. So now we want Medicare tax payable. Okay. And that's going to be, and we're going to follow what they tell us and not add the 50 cents to it. And then we want employees federal income tax payable, because that is the account we put in what we withhold. And there's that calculation is beyond this class. And then the last one is the amount that's going to the retirement savings, right? So those that are saving for retirement that are their employees, they're going to set that aside as well. And then now you can find that plug number actually pretty easy. Okay, pretty easily. So let's see. Okay, so one more time, it should be 53,297 if my calculations are correct. And it is. So you wait to put that payable in last, because it's going to hold whatever this journal entry needs it to so that it's balanced. Okay, onward we go. Installment note. Okay, an installment note. So an installment note is a note that you make certain payments on. Okay, so let me bring in a little table here for an installment note. Okay, so we're gonna, oops. This is number 6, I think. Yes, and then 7 and 8. All right. Okay, so let me show you what an installment note looks like. I think I've got something down here in all my other problems. There is what an installment note looks like. So I'm going to borrow this because this is going to be some of our coursework. So bear with me a minute and see if I can get this up here to help us out. Okay, so this will be what you would want also. Okay, so this is an example of an installment note. Okay, an installment note would be a car payment, a mortgage payment. It's the same payment each time, same payment, right? An installment is a certain payment, same payment amount, paying off a loan. All right, so here's where we're at. Let's see what the principal is. The principal is 35,000. Okay, our interest rate is 9%. Our term is 5 years. not percentages, but 5 years, 5-year term. So I want that just as a number. If I can get it there. Not a percentage. 5 years. Let me put years to the side here. All right. Now the annual payment. The annual payment is $8,998. Now, normally payments are not paid annually. Usually they're paid monthly, but that would really make this very long. Okay, so we're going to do our best to just stick with annual payments. Okay, so here we go. And it's going to look something like this when we're done. So this is allocation of periodic payments or installment note payments. So this happened the first day of the fiscal year. So we don't know what their calendar year is. So we're just going to put January 1. Okay. We're just going to, first day of the year. First day of year. That's fine. And we don't know, I don't think, when their year end. So I'm going to put year end here. Okay. And then year ending. Okay. Year end. And we don't know. They have a fiscal year, which means they're probably not using the calendar year, or they would have told us. All right. So here's what's going to happen. We're going to start with the loan principal. Okay. We're going to start with it. So we're going to start with the loan amount. Okay. We have an interest rate. Okay. Oh, I'm sorry. Let's put in the payment now. The payment's going to happen every year at the same time. And the interest rate that I have on my note is 9%. Okay, 9%. So make sure you put that down. And then when the 9% is here, I'm going to have to take that times 0.09. Yep. No. 9% times 0.09. There we go. And now I'm going to pull this down. Okay, I'm going to pull it down so that it copies everything. So hang on a minute. Let me see what's happening. Okay, let me try this again. So the first interest amount should be 35,000 times 9% times 0.09. Okay, uh-oh. Didn't like that. Sorry about that. So equals, oh. Okay, let me go back. Hold on. I messed up my little table. Darn it. That's okay. We'll get it back. But setting this up, so you'll want to put, okay, so this will make me do this a little better. So what's going to happen here is you're going to take the interest rate of 9% equals the amount here times 0.09. Enter. Okay, there, that's better. So, and then this is supposed to get subtracted for the, okay, so there's the payment. Okay, there's the payment. And then of that payment is 3150, right? And so the decrease in the note. So every payment that we make, which is going to be 8998, 8998, 8998. There we go. That helps. So every payment, the next 4 years of payment, here's what it's going to look like. We're going to take 9% times the carrying amount. The carrying amount is the principal of the loan minus the decrease in the note. So the first part that comes out of every one of these $8,998 payments is the interest. Okay. So we got to figure the interest on what the loan still has left. Okay, this is called the carrying amount. So what's going to happen is the loan was decreased. The carrying amount of this loan is 35,000 minus $5,848. All right, so let's see the installment note. Journalize the entry to record the installment note. Okay, to record the issuance of the installment note. Okay, so I probably have gone too far. That's all right. So this is going to be January 1. Now they're telling us January 1. Okay, January 1. We're going to put this in a note payable. Okay, so I'm going to need some T accounts here. Okay. Oh, hi, Monty. How are you? I'm doing a recording. How's your mom? Sorry to hear about her having troubles. Yeah, I'm recording myself right now so that I don't have to do this again. And so if you just come in and have a seat, I'll try to, I think I still have a Zoomer or two. Yeah, I got Haley, Jackson, Chris, and Oscar, and I'm sure they're going to be bugging out here in just a minute. But okay, so here are the T accounts, and we're getting ready to do an installment payment on a loan. All right, so once again, the loan is $35,000. We have an interest rate of 9% for 5 years. They told us that the annual payments are $8,998. You create a little table that looks something like this. This table is in the book, and I wanted to try to replicate it in my Excel sheet here. Okay, so once again, it goes through, usually these are by the month. If we did this by the month, this table would be a lot longer. Okay, a lot longer. So the first thing we're going to do when we issue the note, and what are we says on the first day, a company issues means to use or sell a 35,000 5-year installment note that has annual payment. So I'm assuming that we got cash. Okay, I don't know what else we're getting, but I think we've got cash. So cash is going to go up for the amount of 35,000, and we're going to create a notes payable. Okay, a notes payable. And here's one thing I'm going to do. Okay, so this notes payable, I always like to put information above that note that tells me what the notes payable, what the terms are. Notes payable. Okay, this is going to be a credit. Okay, so this is going to be 35,000 in cash, and it's going to go in a note payable. And once again, this note payable has 9% interest. It's 5 years with a payment of $8,998. So I like to put that information above that note payable, so I know that that's the terms. All right, so cash is coming in, and we're creating a notes payable for it. Notes payable. So when we make a payment, right, we're going to make a payment now. We need interest expense. Okay, we need an interest expense account, because let me put that down here. Interest expense. Okay, I think we lost Haley and Oscar. That's okay. Jackson and Chris, glad you're still with me. Okay, so now we're going to make a payment. The first payment is the next year. Okay, so now it's time to make a payment. January 1st. Okay, the payment is going to be cash going down by the amount of the payment. $8,998 is how much the payment is going to be. So I'm going to show that here. So this is okay, so this was on January, and it doesn't tell you what year this is. So let's just put January 1. And this is January 1. Okay, and then now it's the next year. So the next year we're going to make a payment, right? This is going to be the first loan payment. So I'll put January 1, first payment. Okay, the payment's going to be a debit or credit of cash of $8,998. And then part of it is going to be interest. Part of the interest, so this is going to be interest expense for this first payment. So we're going to keep interest separate from paying down the principal. Okay. So this is January 1st, first payment. Okay. So it says that the interest is $31.50. Is that what they're telling us also? Yes. It's $31.50. And so I just proved it here in this little table. So we're going to record $31.50 in interest expense, while the other part of this is going to be the principal going down. So the decrease in the note. It's also the principal. Okay, notes have principals. That's the amount you borrowed. Okay, so down it goes for $5,848. Okay, so now let's show that. So we can, let's do notes payable first. I don't know which one they want. Okay, notes payable first, $5,848. And then the second part is interest expense. So when we pay back interest with the note, right? The note in the payment is interest and principal payment. And the good thing about interest expense is we get to use that on our income statement, right? So an interest expense, interest is the cost of borrowing money. You going to stick around or are you going to be on your way? Okay, that's fine. Wasn't sure. Okay, so glad you're here. I'll put you down that you were or that you are. So there you have it. Okay, and that was just the first payment. The second payment would be what you see here. And then the carrying amount of this payable now, which is what we call the carrying amount after you've made a payment, is 35,000 minus the principal part of our payment. And now the carrying amount after the first payment is 29,152. And that's what matches. And then the next year, that's the amount you use to find your interest, right? So you're not going to be paying interest of 9% on 35,000 for 4 years. You're only going to pay interest on the remaining principal balance, the carrying amount. And that gets kind of complicated sometimes. Okay, 2 more, and then maybe we're done. Okay, we're talking about a warranty here. So warranties are guarantees or promises by a company to back up their products, right? Back up their products. So we have to account for those, and these are called contingent. Contingent liabilities mean they may happen. They may happen or they may not. Okay, so contingent liabilities. Let me go down here and put in. All right. So this is going to be our 7th problem. And then we're almost done. Okay, so 7th problem. Looks like we're going to make some journal entries here. So we're going to grab these T accounts and bring them down. Okay, bring it down here. Okay, and get rid of what's in them. It's always handy to have T accounts sitting around waiting. So this is what they call contingent liabilities. Okay, there is some uncertainty, okay, some uncertainty that we'll have to pay them. Okay, but accounting would like for you to set aside money for something that you think you're going to have to pay for so that it's not a surprise. Yeah. So let me, I guess they don't, hang on just a second. So once again, this is going to be an estimated warranty liability. So contingent liability has some uncertainty. They're usually estimates, okay, and this is for warranty. Warranty is a guarantee that if a product fails, it'll be replaced or repaired, right? That's, anytime you buy an appliance, they'll say, do you want the warranty? Well, warranty is basically insurance, right? It's insurance that if your refrigerator stops working after you bought it a few weeks ago, you can get a hold of that company and say, hey, I'm activating my warranty, right? You may have to take the refrigerator back, or whatever, but they're going to stand behind their product because you bought the warranty or it's included in the purchase. All right. So here's what we've got. We need a product warranty payable. So let's do a okay, we need one account that has a product warranty expense. Okay, so that's one account we're going to need. Product warranty expense. So if we have a good product, we shouldn't have to set aside so much money for possible warranty, right? If we have a good product, but sometimes we don't know what's going to happen. So the other account will be product warranty payable. Product warranty payable. Product warranty payable. So, Monty, we're working on chapter 10, and chapter 10 crosses over into liabilities. Okay, we did 4 chapters, 6, 7, 8, 9. Those were all assets.
Okay.
They were all assets. Now we're crossing over into liabilities for a little more in-depth information on those. So it says Qantas Industries sold $275,000 of consumer electronics during July under a 9-month warranty. The cost to repair defects under the warranty is estimated at 3% of the sales price. All right, so let's put in a couple figures here before we start putting journal entries in. Okay, so we've got to come up with an amount. So how much did they sell? So let's put our sales volume. Okay, sales volume. Okay, sales volume is 275,000. Okay, that you need to know if that's how they calculate their warranties, which makes good sense. Okay, makes good sense. All right, I'm going to turn that into a dollar value. All right, so there's probably some data. Whoops, there's probably some data that says, well, of anything we sell, we need to make sure we set aside 3% as a warranty. All right, so their warranty number is 3%. Warranty estimate. Warranty estimate equals 3% of sales. 3% of sales. So that amount would then be equals 275,000 times 0.03. So we're looking at an estimate of what we might pay in warranties over for these products of $8,250. Okay, $8,250. So the first entry we're going to make is to put that amount in. So we're going to put, so this is going to happen on during July. So, record the estimated warranty expense on July 31st. Okay, so this is going to be July 31st that we are going to record this. And we're going to put the 3% of sales in the expense account, and we're going to offset it in a payable. We offset it in a payable, and we wait. We wait to see, and once again, this is an estimate, and we're going to wait to see if any of it gets used or not. If it doesn't get used, then we estimated badly. Okay, our product was good. We can move this around, but there might be a chance that we didn't estimate enough. All right, so let's go through this. Let's establish the warranty over here. So we're going to put July 31st, and we're going to put product warranty expense. $8,250, and then the credit goes to product warranty payable. Okay, so that's going to sit there, and it's going to wait to see if any warranties are activated, right? Well, on November 11th, a customer was given $161 in cash under terms of the warranty. So we're going to have a cash account here. Okay, so now it is in November. Okay, so we're going to make cash go down. Remember, cash has a debit normal balance, but to make it go down, we sent out $161 for a warranty. All right, so this is enacting the warranty, and this is happening on November 11th. November 11th. Okay, so when we send out the cash, then the offset goes to the payable. The offset goes to the payable. So we're using some of what we set aside, right? We set aside $8,250. Doesn't seem like 161 is very much, but that's only one warranty. Okay, that's only one warranty cash payment. So now we're going to do November 11th, and we debit the product warranty payable for the $161, and we pay that customer with cash. So maybe they had to get it fixed. Whatever we're selling, we don't even know what we're selling, but maybe the customer had to get it fixed, and they brought us a receipt. So we paid them back for fixing our product, right? Sending it to a shop or something. So, all right. So that's how that works. And then whenever a customer activates a warranty, we subtract it from the payable. And then at the end of the year, we look and see if this account has a debit balance. If this payable ends up having a debit balance, then we didn't estimate enough. If this account has a credit balance, we may have overestimated that warranty. Let's check our work, make sure we've got it. Okay, last one, my gosh. Okay, last one is called the quick ratio. Quick ratio, okay? There are something called quick assets. And I'm not quite sure why. Oh, I know, because we're using quick liabilities and quick assets. So let me give myself some room here. Okay, and I'm also going to go get the book for just a second. I know this makes it longer, but I want you to see from the book what the quick assets are. It's cash, securities, and accounts receivable, I believe, the last time I looked. So let me go to chapter 10. And this is that ratio analysis that we tend to do at the end of each chapter. Okay, reporting, chapter review, reporting liabilities. By the way, this is how liabilities get reported. Liabilities are broken up into current and long-term. Okay, current gets listed together, right? And then long-term, and there may be some long-term debt that we owe this year. So any portion of the current long-term debt, see how that says current portion of long-term debt? That portion gets put here. So really our long-term debt is $1,749 plus this long-term debt they have there. So be careful, okay? And then here is this short-term liquidity analysis. We're going to use the quick ratio. Quick ratio. So let me get the last basic problem on here, and then we'll stop. Okay, thanks for staying. Jackson, I don't know if you're still watching, but that's okay. That's okay. All right, quick ratio is what we're going to work on. Okay, so let's find out what that is. So here it is. The quick ratio is, so let me snip this for us and put it in my, okay, so this is going to be quick assets divided by current liabilities. Well, we got to know what the quick assets are in order to do this. No, I don't want to save it. I just want to put it in right here. Let's see if I can. Yep. There it is. So there is the formula. Okay, it says quick assets are cash and other current assets that are easily turned into cash. So let me put these down. Quick assets tend to be cash, something called temporary investments. Okay, now you haven't seen those yet, but if they're on a balance sheet, then they're considered quick. And then the other quick one is accounts receivable. So these are based on how quickly we could turn these into cash. So cash is already there, right? Cash is already cash. And then a current liability. So we just looked at what could be considered current liabilities up here. Okay, so now let's go back to our problem. And I got to go find it again, so bear with me. Sorry, taking myself to the ebook dumped me out of, so we just need to go to that very last problem to do these quick ratio. I'll probably get a different one anyway. All right, so this last one. So here is the year before, right? So we got 2 years to look at. Why do we always have 2 years at least to look at? Because you have to be able to see some kind of a trend, okay, a trend, and you don't get really anything by looking at 1 year. So I'm going to put over here year 4 and year 3. Okay, and our quick assets. So let me put in the cash. The cash for year 3 is $890. The temporary investments are $1,400. Accounts receivable are $930. Now they went ahead and gave you inventory just to see if you know, to look to see what the quick assets are. So one more time, quick assets does not include inventory, right? Does not. Nope, because sometimes it takes us a little while to sell our inventory. So we're only going to look at these 3. So the total of quick assets here, we've got to add those up. Total quick assets. Okay, so, and then I've got to put my numbers in for the year before, or year 4. All right, so back to the problem. I think I'm still there. Yes, I am. So cash for year 4 is $940. Temporary investments, $1,100. $810 is accounts receivable. Now we're just going to add these up. Okay, we're going to add them up to see what our quick assets are. Okay, and I believe these are probably in thousands, but I don't know for sure. Doesn't matter. We just want that formula. So there are quick assets for each of the years. Now we need our, we only have one liability. Okay, we only have one. So if there were more than one current liability, we would add them together. But the only current liability that we have is accounts payable. And so luckily, the year before was 2,300 and year 3 was 2,300, year 4 is 1,900. So now we're going to get a quick ratio. Okay, quick ratio. So how we get it is we take quick assets and divide by our current liabilities. So for year 4, we take our quick assets divided by our current liabilities, and I'm going to do that next to it also, and then we want it to 1 decimal place. 1 decimal place, so be careful. I'm not getting that to happen. That's all right. Equals quick assets divided by our current liabilities. Yes. And now I'm going to make these into 2 decimals. So year 3, we had quick ratio of 1.4, and year 5, we have a quick ratio of 1.5. You say, well, what's better? So the idea is this. What this is saying is, if this is our quick assets, and these are our liabilities, for every dollar of liabilities we have $140 of assets. So I'll put this down. For every dollar of asset or liabilities, I can't speak. Okay. For every dollar of liabilities, we have $1.40, or there is $1.40. Okay. There is $1.40 in quick assets. Yeah. In quick assets. See you later. See you Monday. Okay. So there's that. Okay. And so we can make this say the same thing. All right. So for every dollar, so I'm going to put that right here. For every dollar, we have $1.50, right? So which would you rather have? If you had liabilities to pay, would you rather have $1.40 to pay them or $1.50 to pay them? Well, you probably would rather have $1.50 to pay them. So they're moving in a favorable trend. This is a favorable trend from last year, which was 03 to 04. Okay, so it is favorable. It's improving, right? It is improving. That's it. Thank you. Thank you. So thank you for staying, and I'll put this out on Canvas. All right. We'll see you Monday. Don't forget what is due on Tuesday the 18th. Okay, so Tuesday the 18th is going to be 8, 9, and 10. Okay, 8, 9, and 10. So I am going to say goodbye for now. Stop the share. Okay, Jackson, good job. Appreciate you hanging out with me. All right, we'll see you on Monday.